We don't invest in hybrids across my team because we don't believe they're fixed income securities. That doesn't mean that hybrids don't have a place within a broader balanced portfolio, but they need, in our view, they need to be funded out of the equity portion, and that's really because they act like an equity in the bad time and they act like a bond in the good times, i.e. they're negatively convex. So while there is a place for them, they shouldn't be held as part of your defensive portfolio. In terms of lower RBA rates and higher mortgage rates, I think that is certainly, it's a scenario that's possible but not probable. The banks would certainly like to be able to increase mortgage rates here because they're coming under pressure when their margins post the Royal Commission, but it's really about whether they're able to actually increase rates or not. We think the moves in the oil price are really largely geopolitical, and they're not to do with supply or demand. So really what's been happening in Iran, obviously where the US has reintroduced the sanctions and turned off the oil supply from Iran is a key factor, and also what's happening in Venezuela as the government has problems and oil supply dwindles there. Our shorter term view, I've been reasonably bearish on oil prices for the last few years, but our short-term view is that oil prices have more potential to increase from here than decrease. But the key thing to think about in oil prices is we need to think about it and its impact on both sides of the economy. So firstly, higher oil prices will lead to higher inflation rates, and that's quite clear as they feed through to headline inflation. But the second thing to consider is they're effectively a tax on the consumer. And so higher oil prices lead to higher gasoline or petrol prices, which directly impacts the consumer's back pocket. And in the US, this is happening at the same time as mortgage rates are rising. So the consumer is being hit twice on what is already not particularly strong levels of consumption. So that's one of the reasons why we believe the growth levels in the US will slow from here as opposed to increase. Yeah, I think it's fair to say that the Canadian market and the Australian market have a lot of characteristics and a lot of similarities. And arguably, what's been driving both of the markets is immigration. The Canadian markets were the Australian markets on steroids. They had much larger immigration and a tighter housing market, and therefore their prices were driven much higher than ours. And obviously, they're coming off the boil now and are falling quite rapidly. There's less of a swing factor in our immigration, but that said, the valuation levels in Australia are still quite high, and the affordability is worrying. So, as I mentioned, our base case is that house prices track sideways to a little bit lower over the few years. But if we had to pick a scenario against that, we think it's much more likely that they fall rather than rise strongly. It's quite funny that if you look at the US is quite different to a lot of economies in terms of their economics, debt dynamics, and a few things, but inflation is the one where it really is different. So you can make a strong argument, and looking at the numbers, that you don't have a global inflation problem. The Indian numbers, the Chinese numbers, the European numbers are all rolling over and very weak. To give you an example, European inflation is at 0.7%, which is only marginally above the lows we hit during the GFC. But what you are seeing in the US is you are seeing the limits of capacity. So, what we're seeing is from the earlier charts is Trump is enacting a large fiscal stimulus at the same time as we're through the natural rate of unemployment and we're through the output gap. So this has to be inflationary. So we're hearing anecdotes, and across virtually all the wage numbers, we're seeing wages pick up, which is beginning to feed through in inflation. So our belief is the US potentially has a problem in inflation, but nowhere else in the world does. And that's why we believe that the front end of the curve will continue to sell off. And as the front end of the curve continues to sell off, it again drives those yields up in the front end and causes problems for the rest of the world. In terms of the debt dynamics, the US debt dynamics are way worse than everyone else. And I would be surprised were they continue to increase their quantitative tightening program as they have currently planned, and they plan to increase it every quarter. We'd be surprised were they able to do so, because the ramifications of that are only being felt in markets now. For us, the Aussie against the US is really a byproduct of what's happening around the US dollar. So we saw a large, so if you just break the period really since Trump into a number of different time horizons, you can get an understanding of what's happening. So the first one is when Trump was first elected, the belief was that interest rates would go up quicker and the US dollar rallied strongly. And then you came through a few months after that, people started beginning to lose confidence in the Trump agenda, and the dollar started depreciating. Then Trump enacted the tax reforms and the spending cap changes, and the market began to worry about the twin deficits, which saw the dollar weaken up further. Since then, and just the last couple of months, the market got itself very short dollars, US dollars, and this rise in interest rates is beginning to see interest rate differentials coming back to the fore, and this money I've been talking about is coming back to US dollars, driving US dollars up. So when you look at Australian FX rates on a trade-weighted basis, we're not really moving much, which tells you it's purely about the US dollar moving and everything else moving roughly in line. And so we would believe that's going to continue over the short to medium term. In the long run, though, we are reasonably positive on Australia as an idiosyncratic story over, say, the next 5 years. And that's to do about how we're transitioning our economy towards the more service sector, which are tourism and education.